So in this video, we are going to discuss the third core benefit of a cash value life insurance policy, which is the fact that it's tax-free. Tax-free if we do things properly. If you have not had a chance to view our whole life insurance taxes video, I would encourage you to do so. We can also provide a quick overview of it if you're working with someone at our company now as well, because it is a longer video as it goes through the different things that can occur that will trigger a taxable event with a whole life insurance policy. One being a MEC, another example being the policy lapsing with a gain on it. If I cash it out, there are situations that can occur where I have to deal with taxes, and not capital gains tax, but ordinary income tax on the cash value if a taxable event occurs. So I want to make sure I prevent that. With all of that said, it is very easy to prevent a taxable event from occurring. So if your cash value is growing tax deferred and you can access it tax-free, if you're earning 4% tax-free, how powerful is that? It does depend on your tax bracket. Let's assume you're in a higher tax bracket. Would you take a 4% return, an internal rate of return, over, call it a 6 or even a 7% return that you could get elsewhere, assuming that that other return was taxable? And the answer could be maybe. Again, it depends on your tax bracket. Maybe you've got the potential to really hit a home run with that other investment you're earning 6 or 7% on. And for full disclosure, this video is not meant to be one of those videos that states because life insurance is tax-free, it is the best thing since sliced bread and you should abandon all other investments and just put everything into a whole life insurance policy. I never liked that strategy. We see it quite a bit in our industry, but I don't like it. So I'm a big fan of diversification, and most people we work with will diversify. So again, this video is not meant to be an argument that life insurance is better than everything else. But with that said, how powerful is a 4% return if that 4% is tax-free? Also taking into account that the money is liquid. You can access it anytime you want through the loan feature. Also taking into account that it's safe. It's a safe area you can position money. When there are market crashes or economic recessions, when things just are really tight, whole life insurance policies just continue to produce. And a lot of people have benefited from that over the years when we've seen actual policies that have lived the test of time. But what I want to look at here today is taxable equivalence. So a taxable equivalent, what that does is really call it a 4% internal rate of return or a 4% tax-free return and show you what you would have to earn in a taxable account to net the same 4%. Make sense? Let's look at some numbers to clarify. So for example, if I said, hey, I've got this mutual fund or this stock over here that can guarantee that you will earn 7% per year. It's taxable, but you'll earn 7% every single year. How does that sound? Well, it sounds great. Sign me up right now. So if we look at that 7% return, let's take a look, and we'll begin just by punching in 100 grand. We'll keep this simple. Let's assume you're going to pay in $100,000. We'll just call it a one-time deposit. Over 30 years, 7%. So at 7% per year, after the first year, I've got $107,000. Over 30 years, compound interest has resulted in me having $761,000. I paid in 100 grand, so that is a gain of $661,000. Fantastic. However, I did mention that this is a taxable account, so we do need to factor in taxes here. So the question here in this example is, what tax bracket am I in? If I'm in a 10% tax bracket, what does this do? Well, here's a nice column where I get to see what the account grows to without any taxes being accounted for. But then over here, after taxes are accounted for at a 10% bracket, what do I see? I have a net of $625,000. And if I want to look at my actual yield after taxes are pulled out, I'm at 6.3% here. And I've got the account difference as well. What if I'm in the 20% tax bracket? 5.6%. How about 30%? 4.9%. Let's say I'm up near 40%, 4.2%. So I've got this 7% return, And can I get that over 30 years without any risk, without having to worry about a crash or anything like that? The answer is maybe, but probably not, at least in my opinion, right? I'm not a financial advisor, an investment professional, nothing like that. Just looking at history and experience of seeing what people have done with their money. There are definitely places you can put your money and earn 7%. But here, if it's taxable, what happens? If I'm in a 40% bracket, that drags my actual yield down to 4.2%. And if I'm working with an advisor that's going to charge, let's call it a 1% fee, that's going to pull things down even more. So my point to this is when we look at a cash value life insurance product, does the fact that it's tax-free and I don't have to deal with any of this stuff, the fees or taxes really, the fees are the insurance expenses in the product, in my opinion. But if my net internal rate of return is 4%, how much more attractive does that make the whole life insurance product if I'm in the camp of comparing it to other asset classes? It makes it more attractive. So here's an example. This is a high early cash value policy. This is an older discontinued product, but it doesn't really matter what product we use. We can plug in any illustration here, look at any actual values, and here's what we'll see. So this is a case where he's paying in $1 million per year for 3 years. We've got his annual internal rate of return, which we know is the net growth rate year over year. And then we've got the average internal rate of return. We covered what these mean in our last video. The thing, however, to note here, though, is we've got the taxable equivalent. In this example, we're looking at a 40% tax bracket here that this individual is in. He's actually probably in a little bit higher tax bracket, paying $1 million per year in. But if he is earning, let's say in the 5th year, just about 3.6%, that's his annual internal rate of return, the annual growth rate. What that means is at a 40% tax bracket, he would need to earn just about 6% in a taxable investment to walk away with the same net of 3.59% after he pays his taxes. So the question some people will ask themselves is, can I get 6% very easily elsewhere in another investment other than life insurance, if I'm comparing it with life insurance? Even though life insurance is not considered an investment, a lot of people will look at it that way. The answer there is probably yes, especially for someone at this level. However, if we look 15 years down the road, annual IRR, and this is indexing this particular Guardian policy, 5.25% on the IRR. That means he would need to earn 8.75%, and then after he pays his taxes, he'd be left over with 5.25%. If we look at the average internal rate of return, he's averaged out 4.5%, which means he would need to average over 15 years in another account 7.47%, assuming he's in a 40% tax bracket. So that's up there. If we scroll our eyes to the right, what do we see here? Smaller policy, 25% tax bracket. If we look at, let's take year 10, $113,000 in cash value. They've paid in how much? Total of $100,000. Annual internal rate of return, 3.65%. At a 25% tax bracket, they would need to earn 4.86% elsewhere. If we look at the average IRR, 2.3%, which means they would need to earn 3% elsewhere in a taxable investment and then be left over with the 2.3%. They could probably do that. As time passes, though, it does get better and better. And again, this is not meant to argue that one is better than the other. However, it does, hopefully, this solidifies to you or provides a reason why a lot of people do look at cash value life insurance products as that safe, liquid, tax-free area to position money. Because if I can average out a 4% internal rate of return and I don't have to think about it and I can access it like a personal line of credit, and then take into account that to get that 4%, which is a peace of mind product, I might have to do 7% elsewhere, maybe even a little bit better. That might incur some risk. So I might not want to do that. Point to all of this, as this is a reason why some people are attracted to cash value life insurance. And what we can do here, if you're working with us, is run different assumptions at different tax brackets if you'd like to see. And it's pretty simple to do. If you are already working with us, if you've taken a policy out with us, or if you're just consulting with us, with our consulting business, we can absolutely send you that material, no problem, just with the formulas we have plugged in. This way you can plug in your actual cash values and see what the actual net growth rate is on the internal rate of return, and then also see what the taxable equivalent is. In any event, I hope this video was helpful. Let us know if you have any questions, and we will talk to you in the next video. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.